Hello world, welcome to Simply Simplified Finance. In this video, we're going to talk about what a loan is, how it works, and the different types of loans there are. Let's get to it. First of all, why would anyone need a loan? Well, we get loans because we want to buy something. It may be something as large as a property or a car, or something smaller, like furniture or a computer. Maybe it's something as large as a loan to travel the world, to something smaller, like using a credit card for a meal out. Now let's explain exactly what a loan is in terms of finance. So a loan in the terms of finance is just money that is borrowed, aka loaned to you, with the expectation that it's paid back with interest. Now an interest is a percent of that loan that is added on at a given rate that's decided upon when the loan agreement is made. The interest is there so that the person or bank or even company that gives the loan actually is able to make money from it. We'll talk more about interest in a future video. So now we have an idea of what a loan is, but how do they work exactly? Well, it's simpler than most people think. See, first you find out how much money you need and what type of loan you need. Then you go to a bank or lending company to see if they'll give you a loan. The bank or lending company will run a background check and look into your financial history. This is to see how likely you are to pay back the loan. They don't want to give a loan out to someone who doesn't make enough money to afford the bills to pay back the loan, or someone who has a lot of loans already. Now, loans can either be paid back in payments that add a small amount of interest with each payment, or you can pay the payments and then pay it back early. Now, most lenders will allow this, but some may have a penalty for paying it back early. Now, each type of loan is different and has different rules and ways to get those loans. But for now, let's just go through each type of loans that there are. First are the personal loans, which are among the most versatile of any type of loans. It can provide funds for pretty much any purpose, as long as it's not illegal. Individual lenders may put restrictions on what their loans can and can't be used for. For example, you commonly can't use a personal loan for a college education. Next is an auto loan, which lets you pay off a vehicle over time. Typically, the car is what's financed, which means that if the borrower doesn't make their payments, the lender can take the car back and get its money back. Student loans are next. These are used to pay for education and education-related costs. These loans are not supposed to be used for any cost that doesn't involve school. Next, we get to the big ones, mortgage loans and land loans. This is what allows people to buy a house or property without having enough money to pay for the house or property up front. Now, using a mortgage, the borrower can live in the house or on the property without having to pay the full cost up front. However, whoever the lender is owns the house or property until the mortgage is fully paid off. Now, home equity loans are just as versatile as personal loans. Borrowers can use them for just about anything. The amount of money that a borrower can take out depends on the equity in their home, which is the house's worth minus the balance left on the mortgage, if there is any left. Depending on those values, a home equity loan may offer a higher loan amount than a personal loan. Credit builder loans are loans for people who don't need to borrow money but want to establish or re-establish a history of timely payments and improve their credit. With a credit builder loan, a financial institution puts money into a savings account. The borrower then pays an amount per month plus an interest over half a year to 2 years. The lender then reports that there's been a payment each month to the credit bureaus, which helps build the borrower's credit history. Once it's paid off, the borrower gets access to the savings account with all the funds in it. Payday loans are extremely predatory short-term loans that must be paid back with interest when the borrower receives their next paycheck. These loans are usually $500 or less, and the lender will often charge a fee equivalent to 400% plus APR. Auto title loans are loans secured by the document that grants legal ownership of a car. The borrower receives 25 to 50% of the car's value up front and then has to pay it back over a short term, usually only 15 to 30 days. If they cannot pay in full within that period, it may be possible to extend the loan for another month in exchange for additional fees. Pawn shops have their own version of loans. They let people bring in items and receive 20 to 60% of the value in return, depending on the pawn shop and the item. The pawn shop takes temporary possession of the item, but is not allowed to sell it for a certain amount of time. The person who pawned the item can come back at any time during this period and pay off the loan plus interest that was agreed upon. If they do, they get their item back. Otherwise, the pawn shop can sell the item to make its money back. In future videos, we will go in depth with each of these types of loans, how they work and how to prepare for them, and many other facts about them. We'll also cover interests and types of interest in the future too. But for now, don't forget to like and share the video, subscribe, and hit the little bell for notifications on new videos. I'm your average Joe. This is Simply Simplified Finance, and thank you for learning with me today.